Procter Gamble. This April, P&G raised its dividend for the 70th year in a row. 70 consecutive years. A streak that started while Eisenhower was in the White House. On a dividend this company has paid every single year since 1890. And I'll tell you up front on the Main Street test verdict on P&G today. Pass. But the verdict isn't the story this time. The number that decides whether P&G is worth buying right now isn't the streak, or the share price, or the yield. It's a number that's more than halved in 5 years. And it's the reason I hesitated before stamping this one. So here's the plan. 4 rules, one at a time. Then that number, and whether I'd put new money into P&G at today's price. Quick word, this isn't investment advice. Talk to a professional. It's just the test I run on my own money. So why P&G and why now? 2 reasons. 1, you used one of their products today. Tide, Pampers, Gillette, Crest, Bounty, Charmin, Olay, Old Spice, Vicks, Head & Shoulders, Dawn, Tampax. $22 billion brands across personal care, household, and grooming, sold in 180 countries. And 90% of U.S. households have at least one of them in the house right now. That's not a company, that's a utility. 2, the setup on the price is unusual. Most years, P&G trades expensive. Everyone knows it's safe, everyone pays up for safe, and the yield gets squeezed thin. Right now, that's not the case. P&G's yield is sitting above its own 5-year average, and for a stock this loved, that's rare. I'll show you exactly what it means when we get to Rule 3. And there's a date worth knowing. P&G goes ex-dividend on July 20th. Own the shares before that date, and the next payment, $1.09 a share, it done comes to you. That's not a reason to rush. One payment never is. It's just the calendar, and it's why I'm running this test now. So, does the math actually pass? Let me walk each rule. Rule 1, the streak. 10 consecutive years of raises minimum. P&G's streak, as of this April, 70 years. That's one of the longest active raise streaks in the entire S&P 500. Only a tiny handful of companies anywhere have matched it, and nothing else this size has done it. 70 years means P&G raised the dividend through the moon landing, through Vietnam, through stagflation in the 70s, through Black Monday in '87, through the dot-com bust, through 2008 when Citigroup and General Electric cut their dividends to a penny, and through 2020 when half the airlines and half the energy companies froze theirs. And underneath the raise streak sits an even older one. P&G has paid a dividend without missing a single year since 1890. 136 consecutive years. One thing to hold on to as we go, the raises still come every year, but they've been getting smaller. That's the number from the open. We'll get there. Rule 1 verdict. Comfortable pass, 7 times the minimum threshold. Next rule, Rule 2. The cover. The company must earn at least 1.3 times what it pays out in dividends. P&G's cover today, 1.62 times. That's a payout ratio of about 62%. For every dollar P&G earns, the dividend takes 62 cents, and 38 cents stays for share buybacks, brand reinvestment, R&D, debt management, and future raises. Above the 1.3 threshold by a decent margin. Not a generous cushion, but a real one. The direction the ratio has moved over the last 5 years is the conversation. I'll come back to it in the honest read. Rule 2, verdict, pass, 1.62 against a 1.3 minimum. 2 rules down, 2 to go. Quick one. If you're building a dividend portfolio from scratch like I am, hit subscribe. Same scorecard every Sunday. Same 4 rules, different ticker. By the time we've covered 20 stocks, you'll know exactly which aristocrats pass and which ones don't. And the channel is the receipt every time. 2 clicks. Takes 10 seconds. Back to the test. Rule 3, the yield band. 2 to 7%. P&G's yield today, you can see it on the band, sits comfortably in the safe zone. Mid-band, clear of both edges. Here's where P&G gets interesting. Right now, P&G's yield is above its own 5-year average. Why does that matter? Yield and price move in opposite directions. When a stock with a steady raise schedule yields more than it usually does, one of 2 things is happening. Either the market thinks earnings are about to break, or the market simply isn't paying attention. So check the earnings. April's report, organic sales up 3%. Every one of P&G's 10 product categories growing. Core earnings per share up 3%. Steady, unglamorous, intact. The fundamentals haven't broken, which leaves the second explanation. And for a buy and hold dividend investor, a safe stock the market's drifted away from is exactly what you wait for. And remember Rule 1. Buy above the average yield on a company that raises every single year, and each of those raises compounds off a better starting point. On your original cost basis, forever. For scale, P&G currently pays north of double what the S&P 500 yields as a whole. Now, I have to be straight with you. The market has started to drift back to this stock, and that matters for the entry price. Hold that thought. I'll deal with it before anything gets stamped. Rule 3 verdict, pass, inside the band, above its own average. One rule left. Rule 4, the track record. No cut in 5 years and no freeze in 3 years. P&G over the last 10 years, 10 raises out of 10 years, no cut, no freeze, no skipped year. The track record is perfect. But look at the recent 5-year shape. Every year a raise, and every raise smaller than the one before it. 6.5% at the top of the run, 3% this April. The discipline is intact. What that slide means is the honest reads job, and it's next. Rule 4, verdict, pass, 10 of 10. 4 rules clear, framework, pass. But before I stamp it, here's the honest read on P&G. 3 things to know. And then something I owe you about timing. 1. The trajectory on the raises is real. Watch the graph draw it. 5 years ago, P&G's annual raise was 6.5%. This April, 3%. More than halved. That's the number from the open, the one that made me hesitate. The streak holds because the raise is still positive. The direction is the watch point. Companies that drift this way eventually freeze. 2. The payout is creeping up. 5 years ago, P&G paid out 58 cents of every dollar earned. Today, 62. A couple more years of 3% raises on top of low single-digit earnings growth, and the cushion narrows from comfortable toward tight. April's guidance leaned the same way. Management held the full-year numbers, but pointed earnings toward the lower end of the range on cost pressure. The cover today is fine. The cover trend is the watch point. 3. The moat is real, but it's being chipped. Private label brands, Costco Kirkland, Amazon Basics, Walmart Great Value, have gained share in P&G's core categories for a decade. P&G's pricing power is meaningful, but it's not what it was in 1995. And in a saturated category, people don't suddenly start using more laundry detergent. Single-digit price raises are where growth has to come from. Now the timing piece, because clearing the test and being a great entry aren't automatically the same thing. I first built this report in late May. Back then, P&G was a genuine discount story. The stock sat 16% below its 52-week high, and the yield was well clear of its 5-year average. 6 weeks later, part of that story is gone. The stock ran up roughly 6% while this report sat in my drafts. The discount I was ready to sell you has half closed. I could have quietly rewritten the report and pretended the entry was as good as ever. I'd rather tell you straight. The yield is still above its average, but the gap is thinner than it was, and today's price is not the bargain I originally wrote about. What hasn't moved is everything the pass actually rests on. 70 years of raises. Cover comfortably above the line. A clean track record. April's numbers holding up. The price got less interesting. The company didn't. What would make me reconsider? The flip trigger. 3 tripwires. The 2027 raise comes in below 2%. First warning. The cover falls below 1.4 on a quarterly print. Second. Or the yield drops back below its 5-year average, because that would mean the discount has fully closed and you'd be paying the usual premium for the usual safety. And after the run this stock's just had, that third tripwire is live. It wouldn't take much more of a rally to trip it. Any one of the 3 and we retest. Now, the receipt. 4 for 4. The streak, 70 years, clears rule 17 times over. Cover comes in at 1.62 times earnings. Not lavish, but comfortably inside the rule. The yield sits mid-band, still above its own average, and the part that makes today unusual. And the discipline, 10 raises in 10 years, is clean. P&G passes the Main Street test today. So am I buying? Yes, but for the honest reason, not the exciting one. The spring bargain is mostly gone. If you came for a discount, you're 6 weeks late. What's left is what P&G has always been, a 70-year raise machine, still yielding more than it usually does, still covered, still growing. Not a position I'd size up aggressively. 3% raises are what they are. But as the steady Eddie anchor of a dividend portfolio, P&G still earns its stamp at today's price. That's the Main Street test on P&G. 4 rules, the verdict, the receipt. If you found this useful, hit subscribe. And tell me what stock to run through the test next. Drop a ticker in the comments. The test is the receipt.